If you're looking for an option strategy that can really pay dividends for you in a volatile market like this, you're not alone. I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk, and I can tell you that the single biggest question that I've received over the last month is this: what option strategy can I employ when the market is this volatile? Well, if you're interested in an option strategy that actually takes advantage of this volatility and can put you into a situation where, with a little bit of luck with timing, you'll have a very little, if any, risk in the trade when it's fully put together, then I'd stick around, because I'm pretty sure that you're going to find this interesting. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so the strategy that we're talking about today is premised on the idea that the market will continue to have wild swings in both directions, which has been the case since this unprecedented volatility due to the COVID-19 pandemic started in late February. So, for example, let's focus on Alphabet stock, formerly known as Google, and you'll see, for instance, that over the last 8 weeks, there have been multiple examples of Google stock having a large rally on one day, only to be followed by a ferocious sell-off the next day. And so you can see plainly that this is a pattern that is developed on Google stock, which is really actually a reflection of how the whole market has been behaving, as the market reacts wildly to the downside when massive problems connected to the spread of the coronavirus hit the news cycle on one day, and then reacts wildly to gigantic government and central bank rescue packages that are reported the next day. So what some traders are doing in this climate is to take advantage of these relatively predictable swings in sentiment by taking advantage of the unique property of options to structure trades that have incredibly attractive risk-reward features if you get a little lucky with your timing. Now, to understand this session, we need to do a really quick review of the way that options work, so that those of you who are new to options will be able to follow the strategy that we'll be discussing in this video. And if you're experienced with options, just hang in there. This will be quick, and then we'll jump into the meat of the lesson. Okay, so most of you have probably heard of a call option, which is a security that allows a trader to buy the right to purchase 100 shares of a stock at the strike price of that option before the option expires. So, for example, the March 21 Google 1215 call entitles the buyer of that call to purchase 100 shares of Google at 1215 per share anytime before that option expires on March 21st. Now, a put option, on the other hand, entitles the put seller to sell 100 shares of a stock that, say, he already owns at the strike price of that put option at any time before that put expires. People will frequently buy puts on stocks that they own where they'd like to lock in the lowest price that they could sell their shares for to limit their losses if the stock goes down. So, for example, if someone owned a March 21, 1125 put on Google, if Google really tanked, they could sell their shares for 1125, no matter how low Google's stock price got. So, generally speaking, a call option on a stock goes up in value when the stock rallies, because a call option is the right to buy shares at a fixed price, and that right gets more valuable as the stock price gets closer to the strike price of that call. Similarly, a put will become generally more valuable when a stock's price has gone down, because the right to sell shares at a fixed price gets more valuable as those shares drop. So those are the basics of call and put options. Now, let's take a look at an example of what I'm talking about. So let's go back to Friday, March 13th. And as you can see, Google had rallied heavily off of the previous day's close. And so it would not have been illogical on that day to think, well, this has been a seesaw market and we're in the middle of a pandemic. There's a pretty good chance that the market will have some bad days in the future. So let's take advantage of this Google rally and go ahead and buy the 1125 put, which is priced at $38.92. So now let's move to the next trading day, which is Monday, March 16th. And as you can see, sure enough, after a weekend of grim news about the spread of the coronavirus, the market tanked again. And so we take this opportunity to sell the 1090 put 35 points below the put that we own for $40.62. Now, I want you to think about the significance of what has happened so far in this trade from a cash flow perspective. You see, when we first bought the put during the rally for $38.92, remember that represents the right to sell 100 shares of Google. So we multiply that number by 100 to get the true cost of that put option, which was $3,892. With that in mind, you can see why, having sold the 1090 put for $40.62, we received cash in our account for $4,062 for having sold that put as Google sold off the next trading day. So the net cash flow from the trade is $170. Now, the implications of that are pretty huge, as you'll find out in a minute. Now, before we get into the significance of selling the short put for more than we paid for the long put in this example,
I wanted to let you know that there really are sound, viable, long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective technique that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it.
okay, so as I said, the implication of selling the 1090 put for more than we paid for the 1125 put the previous day are significant, because by virtue of our having sold the 1090 put for $4.62, we've actually removed all risk from this trade. Now, why do I say that? Here's why. You see, if no matter how high Google rallies, we get to keep that $170 we received after we net out the cost of the long put from the cash we received from selling the short put. Then, for example, if Google rallies to 2000, a crazy rally, both the 1125 and the 1090 puts will have zero value and just expire with no value on the day that they expire. After all, no one's going to sell their shares of Google at 1125 if the stock is trading at 2000. So that right has no value. The same for the 1090 put below that. That has now no value. They just expire worthless. So now we have a floor on the trade, and that floor is that gain of $170 derived from the original cash flow. So let's take a look at how this trade actually turned out so that you can see the relative risks and rewards of this trade once we were able to sell the 1090 put for more than we paid for the original 1125 put. We'll move forward to March 20th, the day these options expired, and as you can see, Google closes at 1072.30, and so let's examine the values of the options in this trade on expiration day. So let's say that you owned 100 shares of Google and you were protecting them with that 1125 put. Well, in that case, then you could exercise your put and sell your shares at 1125, even though they're only worth 1072.30 in the market. So that means that you would immediately see a gain of 1125 minus 1072.30 per share, or a gain of $52.70 per share, or $5,270, because you own 100 of those shares. But that's not the end of the story, because you also sold that 1090 put. And so you can see that that put entitles the owner that you sold that put to come to you and force you to buy his shares at 1090, even though they're only worth 1072.30. And so the immediate effect on your account of having to buy those is for your account to get marked down 1770. So the value of that option to you is actually a negative 1770, because when it gets exercised, your account will immediately lose 1770 in value. So now pulling it all together, You just saw how the 1125 put was worth 52.70 and how the 1090 put had a negative value to you of 17.70. But remember, you originally paid 38.92 for the 1125 put, and then the next day you received $4,062 for the 1090 put, and so you have to include those in the original transactions in the calculation, as those are all part of the trade. And so when you add the whole thing up, your ultimate profit on the trade was actually $3,670. So basically you made more money because the market sold off, giving your long put a lot of value, even though the negative value of that short put sort of capped the profit you could make on that long put at the end of the day. But you still had a great trade because the long 1125 put appreciated so much compared to the smaller hit you took on the 1090 short put that it was a profitable trade. But in my opinion, the bigger news is that at the beginning of the trade, you took all the risk out of the trade completely, because no matter how high Google rallied, you were always going to at least pocket the $170 of profit from the original two trades, as I showed you. So once you succeeded in selling that 1090 put, which is below the strike price of your 1125 put, for more than you paid for the 1125 put, you had a guaranteed profit with a kind of lottery ticket attached to it. That's because if the market did sell off, as it did, you get a bonus huge profit on top of the guaranteed profit that you locked in the minute you sold that 1090 put for more than you paid for the 1125. And so this is how professional options traders think. They're always looking for opportunities to provide themselves a chance for an outstanding profit, while at the same time limiting their risk on the trade, and in some cases, as in this example, eliminating that risk completely. If they have the options knowledge and a little bit of skill in timing the market, as happened in this trade, where there was literally no price at which a loss could take place, and a wide range of prices below at 1125, where you can make an incredible return beyond the guaranteed profit of $170, they're going to take that trade, and that's the way professional traders think.
Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video. Don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.